Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. And for today's session, we're going to start off with Patricio Alveraz, who's recently taken over our European utility coverage. Right now, we're seeing record European carbon prices. Just this week, they crossed above 60 euros a ton for the first time ever. We're seeing natural gas prices at roughly 3-year highs. Patricio, when you look at the utility space, how do you interpret this boom we're seeing in commodity prices? What's the broad read across? And then also specifically, I know Gazprom reported just the other day. Tell us what you heard and what you think's ahead for them.
Sure. Thanks, Rob. So in terms of the European gas market, we see strong demand fundamentals, first of all, led by a very strong comparative basis from last year, the second quarter, which was the worst of the pandemic. And we've seen a strong recovery, both from favorable weather conditions and also from the partial economic recovery as a whole. The other big driver of prices is subdued levels of LNG imports from Asia. And finally is a shrinking indigenous production in Europe, which has been on steady decline now for some years. So these three pillars drive sort of I'd say a constructive pricing scenario that we see building through at least the end of this year. And that's assuming normal weather conditions. Longer term, perhaps moving into 2022, we see still good fundamentals for a constructive pricing scenario, a bit less so than in the short term. And that's just given the fact that European gas storage levels are at a 10-year low. And this will take a bit more time to refill into normalized levels, independent of weather conditions. So how does this translate into Gazprom earnings? Gazprom's had a bumper earnings season, great results. EBITDA climbed, beat expectations both on EBITDA and net income levels, and which seem to point towards into a record, potentially record high dividend payout. Since Gazprom's dividend plan envisions a 50% payout on adjusted net income. We see the leveraging also accelerating for the company, and given that they have maintained their capex plan unchanged, we see a potential of even a further dividend increase, perhaps in excess of 50% of their adjusted earnings.
Thank you, Patricio. To shift gears slightly, we'll probably come back around on some of the broader discussion, but we also are seeing relatively robust oil pricing. And on that segment, we've got an OPEC meeting. Salih, when we see record high carbon prices, when we see high European natural gas prices, oil's obviously in the mix as well. How's OPEC going to play this? Do they even care what's happening in the other commodity markets? And what's their next move going to be?
Probably not so much. I mean, earlier in August, oil wasn't having a great August. I think it was essentially mainly the Delta worries that kind of weighed on the markets and weighed on oil prices a lot. But then towards the end of the month, we did get those pressure a bit off, and we do have Brent above $70 a barrel again, and we do have WTI around $68 a barrel. So when we look at today's OPEC meeting, I think because earlier in the month there were worries that will OPEC change course, will OPEC do something differently, but we are now back to a very favorable pricing environment for them. So I think looking at today's meeting, which starts at 5 p.m. Vienna time, we are expecting a relatively uneventful and smooth meeting. They are very much anticipated to ratify their scheduled output hike of 400,000 barrels per day in October. The data that was presented to them by the Joint Technical Committee suggests that the oil market will continue to tighten for the rest of the year, which I think encourages them and it reassures them that they can continue to add these marginal amounts for the rest of the year. And I think the bigger challenge when we look at this JTC data that's being presented to them, I think next year is looking a little bit more tricky for them because the JTC is showing them that the market may flip into a surplus next year, and that's not helped by oil demand kind of slowing down a little bit, and also some of the non-OPEC supply coming back notably, and that's namely Brazil, Norway, and of course the United States oil production. So I think looking at just this meeting, I think it's going to be no surprises that they just go ahead with this 400,000 barrels per day. But important to remember that this is their plan to do this every month until September next year. And I don't think they'll be able to do that. I think at some point, perhaps later this year or early next year, they will have to pause or even reverse this course of action.
You mentioned oil demand. I want to get more of your thoughts on not specifically where we are at this exact moment in time, but some of the structural factors that we may be seeing as a result of the pandemic. Our colleagues over at Bloomberg News had a very interesting article looking at the reboot of business travel, and they did a survey, and a lot of business leaders out there are saying that they're going to travel and there's going to be less business travel in the future. Is this something that you think is a reality? Is this a structural step down? And what other kinds of demand indicators are you looking at besides, say, what's happening in air travel for business?
Sure, I think that's a great point, and I thought that was a really good article earlier today on Bloomberg News. I think yes, many of them, and this is something that we talked about on this call as well. So one of the structural changes that we might see on the jet fuel side of things, because a lot of the headlines that we see are talking about road transport and how that's back to normal or very close to being back to normal. And of course, this is the biggest chunk of the oil demand, and it is important. But when we look at the jet fuel side of things, this was about 8% of total oil demand. So this is quite notable. And we have been highlighting that this is nowhere near being back to pre-pandemic levels. And even when things start looking a bit more normal, business travel is a big part of the jet demand. And I think some of it will be back, of course. I mean, it's very difficult to tell where we will be in a few years, but this survey that Bloomberg News did, I think, kind of is encouraging for what we were talking about earlier about how business travel may not be back to how we used to know it, and this can have a structural impact on oil demand. And I think another one that we're watching is teleworking, right? I mean, we are seeing companies struggling with their return to offices. We know quite a few companies have delayed theirs to later in the year instead of August, September period, or even early next year. So more people staying at home, less mobility. This is obviously not good for oil demand either. And we don't think that, I mean, of course, some of it will be back and eventually we will get back to the offices. But I don't think things will look exactly the same as they did before the pandemic. So I think there are read-throughs for oil demand in these things, perhaps more than most recognize.
Very interesting, Salih. Hang on, we'll come back to you. Now, there was another article that I saw flash across the Bloomberg earlier that was talking about the idea that Shell is going to invest in installing 50,000 new electric chargers here in the UK. If you look at the data, plugins are about 17% of new auto sales here in the UK, gone from just a few percent a couple of years ago to something like this in a very short amount of time. So in spite of the pandemic or in tandem with the pandemic, there's this big change happening on the auto side. So Will, you cover the European oil majors. What do you make of where plugins stand and how a company like Shell is responding to it.
Yeah, thanks, Rob. So I think this is a natural extension, really, of Shell's overall energy transition strategy, this is just clearly building out the customer touch points that management has very clearly delineated as a focal point of their strategy, and within the UK, electric vehicle charging expansion has been relatively slow. The UK also has a structural disadvantage for electric vehicles compared to say North America, in that a clear majority of households do not have a driveway. So we have most people in the UK, residents in the UK, have on-street parking, and this creates some significant hurdles for building out electric vehicle charging networks. And so where we see Shell moving with this in the UK is targeting 50,000 chargers by the end of the decade, which would roughly be about a third of the market. And these would nearly all be lamppost conversions. So to try and tackle this on-street parking hurdle that the UK has, but really I think that it's just another sign in the road of how seriously these European energy majors are taking their energy transition, and we're going to see more and more deals like this, not just in EV charging, but we're going to see more upstream power generation being built out from these companies as well, because this is where they see the real value drivers is integrating all the way up and down the power value chain to try and help recover some of that, or to bolster the portfolio returns that don't currently compare that favorably to newer generation oil and gas projects.
Very interesting, Will. Personal anecdote in my life, we just had EV charging installed on my block here in London. I'll be curious to see if folks use it. There's a couple of folks who have Teslas on the block, and they've been running electric cords with these little rubber mats across the sidewalk. We'll see if that continues. I suppose pavement, as they call it here in the UK. But on the broad idea you were just mentioning on emissions, we've got and decarbonization goals. Later this year, we've got a COP meeting. This is the big climate conference occurring in Glasgow. And you actually took a look at the European oil majors, the progress that they're making or not making on reducing emissions. And you put out a note just last week looking at that. So tell us about your research, what you found, and where you think the tier one European oil majors are headed on the question of emissions.
Yeah, thanks. So sort of on the back of the IPCC climate report a couple of weeks ago, we circled back and took a look at the tier one European oil majors emissions reduction strategies, and all of these companies have made increasingly ambitious objectives for how they're going to reduce their emissions in the coming years. But we highlight a key risk here is that the majority of this emissions progress is going to occur, is going to be back-weighted. It's going to occur over the longer term to 2050, with the next 10 years likely inadequate to meet the IPCC's 2-degree pathway. And we highlight that the reduction is coming as a result of divestment of sort of legacy higher carbon assets, some efficiency initiatives, really important production mix evolution. So we're seeing all of these companies become very gradually more gas weighted as opposed to oil weighted, and of course investment in low carbon energy sources. So we've seen a lot more M&A activity in the renewable power space. We just mentioned Shell and EV charging. There's batteries. There's all sorts of interesting innovations in carbon sequestration and carbon sinks as well. But we really think that overall this group has outlined relatively comprehensive and strong emissions reductions plans, particularly in comparison to their American peers. But the pace that is required is going to be insufficient over the next 10 years to meet the IPCC's 2-degree pathway. And I think this is really important because the next 10 years are arguably the most important years to be reducing emissions. So having that back-weighted progress in emissions reduction is not as beneficial to achieving these emissions targets and climate goals.
Very interesting. Thank you, Will. Salih, I want to bring you back on to get your reaction as well. You cover Saudi Aramco. You look after a number of the national oil companies in the Middle East. What do they make of the COP meeting, the climate report, the fact that European carbon prices are at a record high? Do they think it's quaint that Shell is investing in EV charging infrastructure? Are they doing the same thing? How are they thinking about this big mega issue?
Sure. I mean, they're not doing the same thing, and I don't think they will be. I mean, I do expect that we will eventually get more disclosure, and we do have these companies giving us their strategy of how they will do more in terms of their emissions. I mean, when we look at Aramco, their push towards petrochemicals with the SABIC acquisition, of course, should help them tackle Scope 3 a little bit. But I think some of these NOCs, and especially if we look at Saudi Arabia and Saudi Aramco case in point, I think they're in a very interesting place where they are increasingly seeing these international oil majors, especially the European ones, kind of slowly shifting focus away from oil, taking emissions very seriously, and seeing that kind of gap in investment and gap in output growth, where they can kind of come in and grab that market share. So, of course, I think we will hear them talk about climate more often, just like any other oil company. But at the same time, they are still very much focused on increasing their capacity. I mean, we know Saudi Arabia is interested in increasing its capacity from 12 to 13 million barrels per day. The United Arab Emirates has been doing the same for a while and is expected to increase its capacity by another 1 million barrels per day. So I think they're in a different position. They don't quite have as much climate pressure from investors as some of these international oil majors do. And I think they definitely see this opportunity for them to come in. As long as demand doesn't suddenly go off a cliff, they do see demand at least staying around the same levels. And they do see increasing call on OPEC that they think they can respond to by increasing their capacity. So I think when we look at where their production level will be, when we look at some of these international oil majors, slowly we will see them, peaking at some point, I think. Whereas I don't think we will see that for Aramco or for ADNOC anytime soon.
Fascinating to see the divergence there in strategy. It's also apparent between the European oil majors and the U.S. oil majors. I mean, every country or region seems to have a different perspective on this. Now, along these lines, Patricio, I want to bring you back on because a lot of what Will was just talking about in particular, what you're seeing, EV charging, renewables, these are the realm of what I would think of as typically, at least historically, this is the playground of utilities, or electric utilities. So, how do you see this decarbonization push from the European oil majors sort of creeping into what would be the utility-like space? And I would just note that you and Will collaborated on a report out last week looking at the potential for M&A activity and the like in your space. So, but tell us about that report, but also tell us more broadly what's the either concern or lack thereof as the oil companies express more interest in renewables and EV charging and whatnot?
So that's a very interesting question. On the macro level, we believe that just the growth goals on the green on renewables, the ambitions. Let's say that the green transition is so large on the installed capacity targets through 2030 and 2050 that there seems to be enough room for both sectors sort of to pit against each other and compete to build out this massive installed capacity that's needed to meet these goals. I'd say that the downside or the flip side is that this may create some sort of price war, perhaps for assets and for installed capacity, and this has been borne out in recent auctions for offshore capacity for offshore auctions. And we expect to see this also sort of trickle down into the M&A space, driving a spike in valuations and sort of more richly valued assets in general. So that's sort of where it ties into the note that we wrote in conjunction with Will. One of the main things that utilities can go through is cycles of M&A, of spinning off their units or trying to concentrate their business into sort of more breaking up integrated business models into more pure play focused utilities. And this is what the note said for SSE. We, according to our sum of the parts valuation scenario, we saw that this company could gain from splitting up their businesses into networks utility and into a renewable power generator, just to fetch better valuation multiples and sort of ease the conglomerate discount, if you may. And we see obviously the entrance of oil majors into the space accelerating this type of cycles, let's say, and presenting opportunities for utilities also to offload certain assets, especially gas assets. I think that's a big theme for utilities, trying to reduce their exposure to gas utilities and gas networks, given they pose a threat because of their stranded asset risk moving into the energy transition and sort of this preference of electrification over gasification or methanization, if you will.
Very interesting, Patricio. Before we conclude, Will and Salih, I want to get your perspective on this as well. But Patricio was just talking about the idea of sort of unbundling, having specialized entities to capture the sort of best valuation in different components of the market. Obviously, with the integrated energy companies, the energy majors, they're bundling. They're doing the opposite of what Patricio was just talking about. And so, is there any concern, or how are management teams trying to reconcile the sort of various types of return you might get from, say, an oil and gas investment versus a renewable investment or an EV charging investment? We'll go to you first, Will.
Yeah, so it's a good point, and there's several sort of levers that are being pulled at the oil majors to maximize value from these historically lower margin businesses, and one of them is just using leverage. Another is using project financing. We've seen Equinor very effectively be an early mover in the development of some of these major offshore wind farms. And so they have been able to capture significant value from farming down their significant working interests to competitors, which has helped drive major project returns for them. So there are several ways for these companies to sort of optimize their project returns here. But of course, it's not as simple as it used to be for developing much higher return traditional oil and gas projects. And just on the sort of unbundling trend, as you mentioned, ironically, we're also seeing it to a certain extent from one of the companies I cover, which is Eni, the Italian energy major, where they have proposed to spin out their renewables and their retail gas division next year. So I think every company is sensitive to the fact that that they may have business units within their entire companies that could garner much higher trading multiples on a standalone basis, and it would also offer investors clear options between growth and value, between renewables and oil and gas. And so I personally don't think that Eni's proposed spin-out it will be the last one that we've seen. But I do think the many of the other companies will want to build out their scale first before we see similar such moves.
Thank you, Will. Salih, I think you've probably got some interesting observations to share as well, particularly around Repsol or really any of the other companies in your coverage on this same exact topic.
Absolutely. I mean, I was going to mention Repsol, which is, I mean, I would echo what Will said exactly. I think it's a very similar case to Eni. Repsol is the Spanish oil major, and I think for them as well, it just makes sense that they spin off their renewables unit for better value visibility and to fetch some better multiples. I mean, this has been delayed for, I mean, reasons that are unknown to us. But I think Will is absolutely right. I think they will probably eventually go for it, and I don't think they will be the last one either. But I think one important point to make is for these integrated majors that do have a lot of segments, the potential for synergies is quite important for deciding on whether they build more or whether they spin some of those units out. And when we look at what Aramco has been doing, and we look at what OMV has been doing in terms of kind of acquiring in and fully consolidating petrochemicals companies, in terms of in the case of Aramco that was SABIC, in the case of OMV that was Borealis. I think within downstream, I think this just made a lot of sense. They are expecting a lot of synergies that they're probably likely to fetch, because I mean, obviously petrochemicals is using feedstock from the refinery directly, and obviously having those together makes a lot of sense. So we're kind of seeing both for these oil majors, where in some situations it just makes sense for them to kind of absorb these units, and in some cases it just makes sense that these units are for the time being separated out. And then it is very much possible, I think, that in the future, a company like Repsol, after spinning it out, after kind of leaving that unit operate on its own, to buy it back. I think there's always an option for them, but they must be thinking that renewables for the time being may just be better off as a separate unit.
Thank you so much, Salih. We'll have to leave it there. I want to thank everyone for joining us today. We hold these calls on the first and third Wednesday of every month, so we'll be getting back together on September 15th. Reach out to any of us on the call here today if you have any questions. We're happy to chat with you. And of course, if you don't regularly use BI, we highly encourage it. You can find everything that we've been talking about if you visit BI Go. Go read through our written research, and we'll talk to you again soon. Have a great week, everyone.